Welcome to today's talk. Just make sure if you're not speaking that you have yourself muted, please, so that we don't have any background noise. Today, it is my pleasure to introduce Guy Debelle, who has offered to give a talk that I'm sure will be very interesting, since there are a lot of changes happening at the moment, about the state of the Australian, US, and global economies. Guy originally studied here in Australia with a BA degree in economics from the University of Adelaide, and then went on to MIT, where he received his PhD in economics, and has been a very active member of the research group and the alumni group at MIT. He has held a number of positions over the years. One of the most notable ones is he was Deputy Governor of the Reserve Bank of Australia from 2016 to 2022. And after that, he was CFO of Fortescue Future Industries and worked for a number of different organizations over the years, including the International Monetary Fund and the Australian Treasury. He currently has numerous jobs, not just one. He's a board member, non-executive director, and an advisor to numerous organizations. I think I'll leave it at that. And Guy, you're welcome to give some more background as you go through about your many, many years of relevant experience for this topic. So with that, I will hand it over to you, and I will also share the screen with your slides, and just let me know when you want me to move around between the slides.
Yeah, thanks, Evelyn. And thanks everyone for coming along. And Kendra, I'm actually going to reference a bit of your talk from last time as we go through. So, in terms of the macro impact of some of the investment we're seeing in the AI space. So just a bit of background, yeah, as Evelyn said, I did my PhD at MIT in the early 90s in what some of you may have done as course 14. We didn't call it course 14 in the graduate school, but anyway, and possibly, I know a lot of engineers used to take course 14 as their humanities subject because it was the least humanities subject you could do at MIT. And I did actually teach a bunch of engineers as a TA there for a few years as well. So anyway, I graduated with my PhD from MIT in '94, worked at the IMF for a couple of years, International Monetary Fund for a couple of years in DC, and then most of the rest of the time subsequently was at the Reserve Bank of Australia, and as Evelyn said, had 6 years there as Deputy Governor, and left just over 3 years ago now to move to Fortescue Future Industries and stayed there for about 18 months or so, and now I'm on a bunch of boards, both financial and mining, actually. It's on board of a small listed miner, as well as being on Best Committee of Australian Retirement Trust, which is the second largest pension fund in Australia and actually 15th largest or so in the world, just that in perspective. Anyway, that's a little bit of background. What I want to talk today is a bit about where we are from a macroeconomic point of view in terms of around the world. And I will stray into some of the favorite topics du jour, particularly around US policy at the moment. Hesitate the word uneconomic policy, maybe a better way to describe it than economic policy, but policy. And try and provide a little bit of context around that as well. But please interrupt and as we go. The economics department at MIT, when I was there at least, was notorious for basically if you could get through the first sentence of your presentation, you were doing well. So very much used to that. So Evelyn, if you flick to the next slide, I'm going to start with the world and then I'm going to come back into Australia a bit. And I'm going to, all these graphs are from the Reserve Bank of Australia's chart book, which is a wealth of information on both the Australian and global economies in easy to use form and very helpful for presentations like this, and all readily available to the public. So I'm going to go through, if I'm not explaining the economic concept well enough, please ask me, but I'm hoping most people are going to be, I'm staying fairly high level, so people should be fairly familiar with what I'm talking about. So what I've got here is just the annual growth of these three largest economic areas, US, Japan, and the Euro area. And I've shown history over the last 25 years or so to put in a bit of context. And what you can see there is the pandemic very much sticks out with that huge contraction in output in 2020, and then the massive rebound as economies came out of the pandemic. And then if you focus on the far right-hand side, you can sort of see the more recent US exceptionalism. Actually, you can see it throughout this whole period. The light blue line is above all the other lines pretty much that whole time. And remember, so this is growth rates. So growth rates compound. And so if you look at the difference in the level of output, then the US would be just getting further and further ahead of Japan and the Euro area. So that's Europe as a whole, basically, over the last 25 years. But you can particularly see over the last 3 years or so, the US has actually been growing at a historically pretty strong rate for pretty much the whole year. So yes, there was the big rebound out of the pandemic, but actually it's continued to grow at a very strong rate. And some part of that, a decent part of that, is because the US government has been spending quite a lot of money. So the US is running a very large budget deficit at the moment, particularly for an economy which is at full employment. So basically everyone who wants a job has got a job. And so at the moment, the budget deficit in the US is around 6% of GDP, which is a large number historically. And so that is an interesting thing that the current administration's got to address, is how they keep that in check, or whether they do try to keep that in check. So some part of the US outperformance over the last few years is because of very strong growth, but the other part, very much related to what we were talking about at the last presentation, which is the investment, particularly in the tech sector. So to put it in context, NVIDIA's capital investment program for this year is around 100 billion or so US dollars. That's a very large number all by itself. In fact, it's it's of the size of the sort of expenditure of your sort of a few medium-sized countries around the world. So it's a seriously big number all by itself. If you add up the Magnificent Seven altogether, you end up with an investment program, an investment which is adding about 0.5 percentage point to US growth, which is of the order of 3% all by itself. So the sort of tech boom, or particularly AI tech boom in the US this year, is sort of big enough to make a material impact on US growth all by itself. The other thing you can see is that the Europeans not traveling quite so happily. Growth is positive, just. And then Japan, basically, if I did this in level terms, Japanese GDP just hasn't grown a lot over the last 15, 20 years. Now, part of that is the Japanese population growth is a lot lower than that in the Euro area, which in turn is lower than the US, but it's more than that. GDP per capita growth in the US is the strongest, is much stronger than the other two areas. So just to have a bit of a context about what we're at the moment, the US economy is unambiguously strong, in part supported by the US government's fiscal spending. Europe has recovered and actually is in okay shape by European standards at least, and Japan has come out of a funk which has basically been going on since the late 90s and is starting to show some more signs of life than it has for a while. So that's all a fairly positive picture. If you flick on to the next slide, Evelyn. This is the inflation story, which has been front and center, particularly in the US election, in fact, in elections all around the world over the last year or two, and is going to be probably front and center, or is almost certainly front and center in this election here in Australia as well. And you can see that big inflation spike after we came out of COVID, or actually as we were coming out of COVID, because a large chunk of the rise and what drove it simultaneously was the Russian invasion of Ukraine, which drove up energy prices around the world. Throw on top of that the supply chain disruptions that resulted from COVID, which caused prices to go up. Throw on top of that stimulatory fiscal and monetary policy to try and keep economies going through COVID, and all of that led to this very large rise in inflation. And as you can see from the history, those spikes, this is the history only back to the 2000s, that spike is much larger than people have experienced for quite a long time. If I were to take this back to the 70s and 80s, this spike would not stand out, which I find is interesting around in terms of the sort of cost of living pressure narratives we have at the moment. It's like, yes, there was a very large hit to people's spending power through that because of those inflation spikes. But as if you go back through the 70s and 80s, this was pretty much the way things went through much of the 70s and 80s. So it's just, but we'd had this period of benign inflation for the better part of 20 odd years, and it's sort of gone off people's radars, and then it came back with a vengeance in 21, 22, and suddenly people decided that they really didn't like inflation, which is interesting from an economic point of view, because if you flick to the next slide, so unemployment, so the two things people generally care about are unemployment and inflation, or their real spending power. And from an unemployment point of view, you can see the spike during COVID in terms of measured unemployment. But you can actually see that after that, both in Europe, Japan, and in the US, unemployment's basically stayed pretty much close to the lowest it's been for the better part of 3 decades. So from a central banking point of view, if you think that the ability to get inflation down without sustaining a large or even any material rise in unemployment is actually a major success. However, the population doesn't seem to be wanting to reward governments for that, because they're still not happy about that large rise in inflation. And populations are never good at understanding counterfactuals. So they think, well, the unemployment rate's low and I've still got a job because I deserve to have a job, not realizing the counterfactual historically has generally been, when we get inflation down, unemployment goes up quite a bit. And you can see that even back in around the time of the global financial crisis, the sort of material rise in unemployment back then. This time around, people basically held on to their jobs one way or the other. No one knew anyone who's unemployed, and no one appreciates the counterfactuals that things could have been a hell of a lot worse. And the cost of the insurance policy of not having everyone lose their jobs was, in part, a short-lived but decently large rise in inflation. So it's interesting from the sort of cost-benefit analysis of all of this, and that people's abilities to appreciate the counterfactual was actually, you've got to be careful about saying you've never had it so good, but actually you've close to never had it so good. But that's not the way that people feel. And some part of that is, if you look at the wages side of things, and I wasn't able to do this in real terms with my current tech skills, but people did suffer a decline in real spending power. So what I mean by real spending power is, how much you can buy. Your wages are going up, but not as much as prices are going up. Your real spending power is going down. That happened through sort of 21 and parts of 22. And people really didn't like that. It wasn't a particularly large decline in real spending power, but it was enough that people noticed. And it was particularly in things that people buy regularly, which is petrol prices. Obviously, energy prices went up a lot. A bunch of sort of household essentials prices went up a lot. And the things you buy less regularly, their prices tended not to go up quite so much. So it was sort of very obvious and very much a direct hit on people's hip pockets. But as I said, interesting from a sort of long economic perspective that, as I said, this is one of the most successful disinflations that's ever occurred. And it was pretty much the case all around the world that we got inflation back to sort of close to the levels that people want, or that is the sort of targeted level, without any material rise in unemployment. And that narrative really isn't that pervasive. It's all about the cost of living pressures, not the fact that actually everyone's still got a job, which, as it is, so from an economic policy maker's point of view, it's an ideal outcome. From a political point of view, not quite so good for them.
Guy, can I ask a question just about the unemployment rate, and just thinking about the role of the the baby boomers moving from full-time work into transitioning into retirement? How does that affect the story about the unemployment rate going down? Because I know that's certainly a factor, right?
Yeah, and in fact, so that varies quite a bit country by country, and I'll come on to it when I've got a similar graph in Australia shortly. So what you see vary quite a bit around the world is another economic concept called participation rate, which is whether you're actually employed or looking for work. So the participation rate in Australia, because not everyone participates in the labour market, a lot of people choose not to, and that's fine. But the participation rate in Australia, for example, is the highest it's ever been, and that's because we're seeing older workers in particular stay in the workforce rather than retire. Then you can ask whether this is voluntary or involuntary, and there's mixed evidence on that. So part of it is because we're living longer, people want to work longer, not necessarily full-time, but at least part-time. But some part of it is partly related to the cost of living story, is, well, they have to keep working to be able to have enough money for retirement, or to be able to afford housing and things like that. So, so the participation rate is, in Australia particularly, is at all-time highs. In the US, not quite so much. It's at high levels, and you're seeing more participation from baby boomers. Australia has always had a larger share of part-time work than other countries, but also fairly prevalent in Europe too, but less so in the US. So it's been easy, that the labour market is sort of more set up to absorb, or allows people that option. But we are seeing we are seeing participation rate as cohorts move into older age brackets, participation rates continue to rise. Some part of that is female participation has been on an upward trend for the better part of 40, 50 years, starting to level out now. But as more females move into those older brackets, they've got higher participation rate than the cohort that preceded them. But we're also seeing it from older age males, and particularly in part-time work. So it does affect the unemployment rate to the extent that those people are looking for work and not finding it, but actually they're finding work, basically. The only challenge, I suppose, with your choice at that age is probably if you either stop looking for work, then you leave the labour, what the statistician regards as the labour force, so you don't necessarily push up the unemployment rate. But unemployment rates right across the demographic, right across however you want to cut the demographics, are basically close to sort of 30, 40-year lows. So, Evelyn, if you want to flick on to the next slide.
I will. I just wanted to ask a quick question on this slide as well, if that's all right.
Yep.
So if you look at the unemployment rate, one thing that stands out to me is the big spike with the US around the pandemic, which looks a bit higher than you had in Europe or Japan. Is there a reason for that? Yeah,
so it really depends on, and you'll see it. So the US, Australia looks like Europe when I show that graph in a minute. And that's all down to the labour market policies that governments employed. So we had JobKeeper here in Australia. Europe, sort of something similar. US did not have that, or nothing like that. So the policies in Australia and Europe were very much designed through the pandemic, were designed to keep that attachment between a worker and their company. US, not that. So the US, you see this large rise in unemployment, and then those links were broken. And then actually it was interesting, as the US started to emerge from the pandemic, then you can see it. That large spike in wages growth in the US is companies having to hire those workers back after having broken that connection with them. You didn't see that anywhere near so much here or in Europe because that connection between the worker and the company was maintained. So you had all those stories, if you remember, as US came out of the pandemic, about no wait staff in restaurants because they'd let them all go and then had to, struggling to find them in short order. Whereas here in Australia, JobKeeper meant that as long as the cafe stayed open, then their workforce was still there. Their workforce remained there. And so when they did reopen, they were able to bring them back very quickly. So
interesting. Thank you.
Yeah. So it's all down to the labour market choices, policy choices. If you flick to the next slide, just talk about monetary policy, you can see the very large reduction in interest rates into the pandemic in the US. Japan was already basically maxed out in terms of its policy rate. Europe, similarly, there's a debate which I won't go into here, but if anyone wants to talk about later on, about whether negative interest rates are a good or a bad thing, which is the pandemic provided some evidence on. But you can see policy rates basically bottomed out into the pandemic. Central banks also expanded their balance sheet, what's known as quantitative easing, to provide additional stimulus. But then you can see, as we came out of the pandemic, very quite rapid rise in interest rates and a decently large quantum of interest rate increases as well, reflecting that large rise in inflation and reflecting the fact that actually economies were actually traveling pretty well. And then you can see over the past year or so that reduction in interest rates in the US, slightly more in Europe, back to the levels which in the US you would describe as somewhere where monetary policy is sort of neutral, which means it's not providing stimulus to the economy, nor is it particularly contractionary for the economy. Obviously, the president of the US would like US interest rates to be considerably lower than they are currently, but as I showed, the US unemployment is basically somewhere around full employment. Everyone pretty much who wants a job has got one. And inflation has come down, but is at an okay level, but not, is slightly above where the Fed would want it, which is not normally the recipe for further interest rate reduction. So anyway, we will see how that plays out over the coming months. Flick to the next slide. I'll just talk a little bit the other two big economies or economic areas. So China and India. This is if I take, you can see the scale here is quite different. So China and India in the early part of this graph were growing at around 10% per annum. That reflects their lower state of economic development. And so if you think about long run trend growth in the US is maybe somewhere around 2.5% per annum. China and India were a long way behind. If you think of the US as sort of roughly defining the economic frontier, China and India were at a lot less stage of economic development. So there's a lot of scope for them both to catch up. So they're able to maintain these growth rates of sort of 10-ish% for quite a long time. Through the sort of 2010s, China's sort of slowed as it started to catch up. It's sort of trend growth rate or potential growth rate, for want of a better term, was probably more around 8%. And now the current argument is whether that's come down to an even smaller level as they're sort of starting to approach a similar-ish stage of development. Chinese population is also, as well documented. They're basically, is at a very low level and decelerating. So that also has an impact on their potential growth rate. That's clearly not true in India. But the current plan of Xi is that has China growing at around 5% per annum. That's possibly ambitious. But China has been struggling a bit on the growth front over the last few years. India is a completely different story. I just put there for context. They still have plenty of potential to catch up, but that's been true for quite a long time. They've done okay over the last 20 years, but still are a lot further behind the economic frontier than China is. But one of the challenges at the moment that China is facing is its economy is not particularly strong. A lot of that growth is coming from the export sector, which is them exporting everything else to the rest of the world. Clearly, the US president not very happy about that. And in this case, not necessarily the only ones. The Europeans aren't particularly happy about the Chinese dumping a whole bunch of cheap goods on their market. So they're sort of pursuing they are pursuing a strategy of export-led growth. At the moment, they're providing a lot of support to their export-oriented companies to maintain that growth. The Chinese domestic economy isn't going so well, most notably its property sector, where there's been a fair chunk of overbuilding over the last number of years, and a number of high-profile Chinese property developers have gone bust, basically. If I'd gone back to the sort of 2010s, Chinese growth strategy was, yes, there was an export element to it, but there was a lot of domestic investment in infrastructure, a lot of house building as China urbanized. All of this was clearly very good for Australia, because one of the main things you need for that is steel, and hence our iron ore, and hence the very strong growth of Australia's iron ore exports to China for the better part of 20 years. And so it's an interesting challenge or question for Australia is, if China's growth is going to be less steel intensive going forward, what does that mean for the Australian economy, and particularly the fact that our largest export is iron ore. So I'll come on to that in a minute. But in terms of where things are at the moment, China's economy not quite as strong as it's been for much of the last 20 years, and that plays into sort of the geopolitics at the moment, particularly with them pursuing export-led growth, and that engendering these responses most notably from the US in terms of tariffs, try and discourage that, or at least make those goods a lot more expensive. But it's not just US in terms of that response to China. The Europeans have also imposed tariffs on China's exports, particularly of EVs and the like as well. So let me talk a little bit about tariffs, as it seems to be the policy instrument of choice of the new US administration. Though that said, when Trump was in power, president in his first term, he imposed tariffs on Chinese imports. Those tariffs were maintained and actually slightly increased under the Biden administration. So this is one area where there's a reason, Chinese tariffs at least, is one area where there's a reasonable amount of bipartisan support in the US. Trump, in the last 24 hours, has come out and said that in addition to the already announced 10% increase in tariffs, he's going to actually increase them by even more in terms of tariffs on China. So it'll be an extra 20% or so increase in tariffs from a level which was already around 15% or so. So what that does is increase the price that US companies, US importers are paying. So it makes those Chinese goods more expensive. If you don't have any other source of those goods, you just pay for that in terms of higher prices, both as a US company or as a US consumer. And so that is inflationary. And so one element of the current US administration's policy in terms of increased tariffs is unambiguously inflationary, unless there's a movement, unless the US dollar goes up and offsets some of that, which they're sort of hoping happens a bit. But whatever it is, it increases the price of those Chinese goods. The plan is to try and onshore some of those activities that, those industries that China is doing, but that doesn't happen overnight. And in the meantime, you're paying higher prices for those goods. So anyway, we will see how that plays out. But that it, and clearly they've also announced potential tariffs on Canada, Mexico, Europe, and then this across-the-board tariff on pretty much everyone as a sort of retaliation from any perceived economic injustice they feel they're getting from any other country in the world, including countries like Australia, where they've said, oh, well, you have a goods and services tax that applies to imports of goods from the US. That's 10%, so we'll stick a 10% tariff on any Australian export to the US. And it's not just that, any other, they'll look at our quarantine and say, well, that's a impost on US agriculture, so we'll apply a similar tariff on Australian exports to the US. Interestingly, Australia is one of only 3 countries in the world which runs a trade deficit with the US. Everyone else, so that means the US has got a trade surplus to us, i.e. they send more exports to us than we send to them. We are only literally one of 3 countries in the world where that's true. So part of Trump apparently doesn't like trade deficits. Well, not apparently, he says that quite openly. We are one of the few countries in the world with which the US has a trade surplus. So whether that buys us any slack, we will see in the coming weeks. But from an economic point of view, trade deficits sort of are what they are. It's very, they just reflect the sort of flow of goods and services across borders. And some countries are always going to be running a trade deficit, and some countries almost certainly always going to be running a trade surplus. And this is generally, from an economic point of view, cross-border trade in goods and services is a good thing. And as I said, they're almost certainly never going to be in exact balance, certainly in terms of bilateral positions across countries. So anyway, economic logic does not necessarily apply to a lot of the sort of things that the current US administration is considering, but we are where we are. So anyway, we will see how that plays out and how much of that is a threat and how much of that actually comes to pass, which at the moment is still is highly uncertain, I suppose. Let me just flick to where we are in Australia. If you flick to the next slide, this is Australian growth. And you can see, I've taken this back over a longer period of time. Through the sort of 90s, we probably thought of trend growth in Australia was around 3%, probably stepped down to around 2.5, 2 3/4 through the 2000s, 2010s, and now possibly a bit lower than that. You can see that very large contraction again around the time of the pandemic and a very large rebound. For a couple of quarters, there was actually the 2 largest contractions in GDP we'd ever seen in history. And then the 2 largest rebounds in measured output. So it turns out that when you shut an economy down, it has a fairly material impact on activity. And then when you open it up, that unwinds. But as I said, now, over the last few quarters, so if you look at this is the little bars are quarterly, and then the lines are year-ended growth. In the last few quarters, you can see the bars actually aren't that big. So growth has really been quite anemic in Australia now for the better part of 12 to 18 months. And that's in part, or in large part, because we had had a period of high inflation. The Reserve Bank had tightened monetary policy to slow the economy, and the economy indeed did slow to try to bring down inflation. So if you flick to the next slide, Evelyn, let's just show you what actually has been happening. Then I'll try and explain the narrative going on at the moment. So if you look, this is GDP over the past year. So it was growing at about 0.8%. That's the bar on the far left. So in economics, we try and break it down into what are the contributors to that growth? What's the main driver of that growth? Just remember, which I think is something which is often lost and people talk about GDP. The GDP is measured as a level concept. So we think about what is the total amount of activity going on in the country at any point in time. So that number's quite a big number, a bit over, it's about $1.5 trillion, I think, these days, activity each year. Then we measure, so that's a big number, and then we look, and then the statistician measures the change in that number. So that change is a small number on a very big quantity, which is often lost a bit in the translation. Anyway, what you can see here is that government-related expenditure contributed more than the total growth in activity over the past year. So that government bar is about 1.2 percentage points, contributes more than the total growth. So this is the narrative around, oh, well, if we didn't have that government spending, the economy would be in recession, which is somewhat disingenuous.
Guy, just a really quick question. Do you have any insights on how the government spending breaks down in terms of different types of government spending or where it's been going?
Just about to come on to that, Ulrich, actually. So a fair chunk of that spending over the past year has been health related, that growth in spending, and NDIS. And you can see that particularly when we come a bit later on to look at employment. I think about more than half of the growth in employment over the past year, which has actually been pretty strong, has been in healthcare or the health sector, and a lot of that NDIS related and directly related to this increase in government spending you see here. So the growth in spending has been particularly strong in the health sector, in government-supported health, which is mostly a large chunk of which is NDIS of the growth at least. So that's been a fair chunk of the growth. But you can also see that, consumption, which is household spending, has been growing a little bit, not a lot. It normally grows more in line with the aggregate growth in the economy. So it's been pretty subdued. You can see the mining investments actually been declining. That's mostly because a lot of that is driven by the three large mining companies. They've pretty much maxed out their capital expenditure programs for the foreseeable future. Those mines are roughly operating at full capacity. They're not developing a lot of new mines. And so those big capital expenditure programs that we've seen over the last 30 years, they're just not happening at the moment. They're maintaining the level of their investment, but they're not increasing it further. As I said, just to compare, if you go back to the 2010s, mining, this is this sort of Australian equivalent of the capex boom you're seeing in the US at the moment. Mining investment more than accounted for all the growth in the Australian economy for a number of years. But a lot of that mining investment's imported, and so it doesn't contribute directly to Australian GDP. But you can see the rest of the non-mining investment, so investment by the corporate sector outside the mining sector, has actually been going along at an okay pace. And then we've had a bit of a contraction in exports. Some of that is commodity related, but some part of that is also education related. So for those of you in the education sector, that's a direct outcome of the potential clawback in international students, and we'll probably see even more of that in the year ahead. So education exports, which are a decent chunk of Australia's exports, are actually going backwards. So education exports means the number of international students we educate in Australia, basically. But so as I said, this is part of the narrative at the moment, that all of the growth at the moment in Australia is being driven by the government sector, which is not completely true. As I said, the business sector is investing, the household sector is spending, just not as much as it normally does. We flick to the next slide. I'll just talk about the labour market. And sorry, this is a bit busy, but I couldn't get a graph of the light I just wanted off the RBA site. So the light blue line is the unemployment rate, and that's the main line. That's the sort of headline number that you mostly focus on. And I've taken this a long way back to make the point that the current level of the unemployment rate is about as good as we've had since the early 70s. And the composition of the labour market today is massively different than it was in the early 70s and the 60s. Back then, nearly all work was full-time, and nearly all of the workforce was, a large chunk of the workforce was male. Fast forward to today, female participation is lower than males, but not by a lot in the labour force. And we have a very large chunk of part-time work, a lot of which is actually is what people want. It's not forced on them. And to that point, that is what the underemployment rate measures, is how many people who want and are available to work more hours. If I'm in a part-time work, if I'm a part-time worker but I want to work more hours, what does that look like? And that's that sort of dark blue line there, which sits above the light blue line. So that's sort of a number you can keep. A lot of your average part-time worker works around, or the median part-time worker, i.e. the most common part-time worker, works around about 3 days a week. Some number of them want to work 4 days a week. They don't necessarily want a full-time job, they just want to work more hours. And that's what that dark blue line measures. And even that is as low as it's been for the better part of 30 years. In the early part of that, back in the 80s, there just weren't so many part-time workers. But whichever way you want to look at it, the labour, most people in Australia at the moment who want a job have got a job. Whether it's exactly the job they want might be a different question, but nevertheless, if they want a job, they've basically got a job. And again, here in Australia, like in other countries, we've had this large decline in inflation without a particularly large rise in unemployment. It's sitting around about 4% at the moment, which would be is a great outcome any time over the last 40 years or so in Australia. But again, that part of the narrative seems to be, is often lost around the sort of cost of living pressure narrative. That, and as I said, it's partly because I think people don't appreciate the counterfactual, which is unemployment could be a lot higher. And in fact, the example some of you may possibly painfully remember, if I go back to the late 80s, early 90s, you can see where unemployment got to 11%. When I left Adelaide in late 80s, early 90s, unemployment in Adelaide got more like 17%. And so then not only are you fairly likely to be unemployed yourself, you almost certainly know quite a few other people are unemployed. At 4%, almost certainly you hardly know anyone who's unemployed. And I said, we avoided that large rise in unemployment to bring down inflation this time around, which I think is quite a material macroeconomic achievement. If you flick to the next graph, this is the point I was making earlier. So this is the participation rate, is people who either, of the people 15 years and over who are in, either got a job or they're looking for work. That's at a historic high. The employment to population ratio, which is just the number of people in a job relative to the total population, also at an historic high. So, we've got the most labour market engagement that we've ever had in the country's history, which is also just shows the overall healthy state of the labour market. If I flick through to maybe skip that one, Evelyn, just on to the next one. So this is the inflation story, and you can see that large spike here. But I actually did include some part of the late 80s there, where, for most of the 80s, for those of you who can remember, were economically aware back then, or even alive, we averaged about 8% inflation through a large chunk of the 80s. And everyone just got used to living with that. Probably wasn't a good state of affairs, but nevertheless, it's interesting to put the most recent inflation spike in that perspective. So we had a period here where inflation got above 8% a couple of years ago, but it was a fairly short-lived spike, and now inflation is back below 3%, in part helped by those energy rebates that you're probably receiving from the government at the moment off your energy bills. But anyway, it's back below 3%, and the most recent run of inflation numbers has been more benign, and that's given the Reserve Bank's space to reduce interest rates at its most recent meeting was because this inflation picture has come, is back more where they want it, and notwithstanding the fact that the labour market still remains pretty healthy. So, that they raised interest rates, that contributed to that weak growth. We saw inflation come off. It's now come off, mostly in line with how they were wanting it to come off, and so they've been able to ease interest rates again as things, the economy sort of gets back to an even keel in terms of inflation and actually in terms of labour market outcomes.
Guy, can I ask you, related to inflation, obviously not everyone in Australia or in the world is checking these numbers every day. A lot of people don't have an awareness of it. They're just thinking about what their grocery bill is costing them.
Yep.
I'm just thinking yesterday I ran into my neighbor when I was walking the dog and had one of the conversations we've had many times over the past couple of months or a couple of years about, groceries are still so expensive. Have you tried switching to Aldi, so on and so forth?
Yeah.
Psychologically, how long does it take a population to sort of settle when these numbers come back down?
Yeah.
Because kind of overall, their grocery bill is still higher than they remember it a couple of years ago.
So great question. There's a couple of different ways to unpack that. So first of all, inflation is a rate of change. So what you don't see here is, except for a very brief period in 2020, which was more because of, again, COVID related stuff, it's not negative. So your grocery bill went up and it stayed up, but it hasn't come back down.
And it's still going up.
But now it's going up at sort of 2%. So yes, it's still going up, but not, fruit and veg prices do go up and down, but your grocery bill as a whole it's growing on the recent numbers, it's sort of around 2.5%, basically in line with the rest of the basket. But as to your point, it hasn't come back down. But in the meantime, and I skipped over the graph, but your wages have actually gone up. So as a share of your overall bill, it's starting to come back down again, but that's not the way people think. One of the people have what the economic profession at least is called money illusion in any number of forms, and this is one of them. So they think about, and part of the challenge here is actually for most of the 2000s and the 2010s and up to 2020, inflation was actually at a level where no one really paid any attention to it. Alan Greenspan used to say that his definition, what was the desirable rate of inflation, was a rate of inflation where no one paid any attention for it. And that was basically the world we were in for the 20 years prior to 2020. And so it just went off people's radar screens completely, basically. Whereas it's come, as you said, right back onto people's radar screens. How long is it going to remain on that? Not really sure, but I would say it took, so if I go back further in history here, you can see that period, well, after we came out of the 1990s recession and inflation settled down around 2%, I would say it took pretty much the whole of the 90s and into the 2000s before people sort of accepted that inflation was going to stay at around 2% and they could forget about it. So now that was after a much longer period of higher inflation than we've had most recently. But I think I suspect it's still going to take another year or two of people getting okay wage rises and prices not going up till they stop thinking about inflation again. The other challenge, though, and it's almost it's always impossible to have an economic talk in Australia without talking about house prices, and so I've got to talk about house prices. Is the one part of people's cost, the one part of cost of living in the biggest chunk of cost of living is the cost of housing, and that has gone up a lot and stayed high. It's the highest, pretty much the highest it's been as a share of household income in history, and it's higher in Australia than pretty much anywhere else in the world. And that, I think, is a lot of times what people are thinking about in terms of cost of living pressure is the cost of housing. I think the grocery bill pressure probably will go away in another year or two if inflation remains at these sort of levels, but the housing one probably isn't going away anytime soon. But this is actually, your question is a really good one, and the one that the sort of economics profession is trying to think about. A slightly different way of thinking about it is, are people's overall expectations of inflation anchored? And the answer to that seems to be mostly yes. They're sort of expecting it to come back to somewhere around 2.5 again, which it has. And it didn't seem to become particularly de-anchored, even though we had that period of higher inflation over the last few years. But and part of the other problem is there's a sort of recency bias. So you look at your grocery prices, once a week at least. You forget about the fact that your phone is, which you only buy maybe every 2 or 3 years. It's either price hasn't gone up, but you're getting a hell of a lot better phone for the same price, or in some, or its price has actually come down. Motor vehicles is another great example. You only buy a car, every 5+ years or so. The car you're getting now is a hell of a lot better than the car you got at the same price point 5 years ago, or potentially is actually even cheaper. You're not making those purchases with anywhere near the frequency that you are your grocery bill. And so so grocery and petrol prices are the ones that people pay, most aware of, and they're the ones which move around a lot, but it's those lower frequency purchases where actually prices have tended to be declining over the last 15, 20 years. And people just forget about them when they're trying to assess, make their assessment of what's happening in inflation. So anyway.
You only have that conversation with your neighbor once every 5+ years with the car, for example.
Yeah,
so
just
what I feel like I have every time I go out for a walk.
No, just remind them, and we're probably, the other high frequency purchase is coffee, right? And because of the shortage of coffee beans around the world, everyone's coffee prices are going to spike in the next little while. But yeah, it's the consumer price is offered the consumer price basket that the statistician measures. They update that pretty regularly, so it is reflective of once a year now at least. So it does adapt as household spending patterns change and as their expenditure shares change. The other thing it does, though, is it tries to take account of quality in measuring inflation. So if a price goes up because you're getting a materially better good, it'll be a much better phone, for instance, they try and take account of that in measuring the price, which is something that people sometimes have a bit of trouble. As I said, you're getting a lot better basket of goods and services today than you did even 10 years ago in terms of the quality you're getting, and you're not paying all that much more for it actually.
So Guy, technically we only have 5 minutes left in the talk. I'm happy to go over time, and I think people are interested, but I'm not sure if you want me to jump ahead with some of the slides.
Actually, I didn't have too much more I really wanted to talk about. Let me just flick on, given we've got a few people here in the education sector, if you just flick on a couple more, we get to exports. I'll skip it. So just to put this, go back one slide, sorry, and just put that in splits. So this is the quarterly exports that Australia sends offshore each quarter. So just to put in perspective, look, the scales on the left-hand side and the right-hand side are massively different. So resources are by far and away Australia's largest export. And then on the right-hand side, number 2 is services, that combines tourism and education. But education of itself is number 2 after all the resources. And then you can see, and it's larger, service exports, so tourism and education are larger than rural. And then manufacturing in Australia is not a particularly large number, and it hasn't been for quite a long time. So we import a lot of manufacturing, mostly obviously from China. And this is the narrative around Australia is mostly is just one big quarry which it sends to the rest of the world, which is that very large resource number, which is iron ore largest, and then the 2 forms of coal, sort of 2 and 3. And it's an interesting question then about what this future looks like. One, as I mentioned earlier, is China going to be buying less iron ore going forward as the share of steel in their economy becomes less through time? Is anyone else, is India going to step up and buy more? India does buy some iron ore. Are they going to step up and buy more? What does our exports, a large chunk of that resource export is fossil fuel exports in terms of coal and LNG. Sorry, that was the other big resource export, which is in there, which I forgot to mention. So are we able to shift from exporting fossil fuel intensive energy to green energy? Because we do have the potential to do that in terms of our abundance of solar and wind in particular. How do we export that green energy potential to the rest of the world? One of the reasons I was at Fortescue was they were looking at green hydrogen. Probably not the vehicle we're going to be exporting green energy to the rest of the world anytime soon, but there are other ways we can do it. Most obviously green iron, which is combining that iron ore with green energy. That's a potential large future export market for us, very much in a nascent stage at the moment. But anyway, it's an interesting thing as to what this is going to look like going forward. And we're probably fairly close to a tipping point in terms of particularly coal, but also possibly in the iron ore space as well. That was just, and if you flick to the next page, Evelyn, just show you where does it all go. China, basically, is where a lot of it goes. But the 2 and 3, though, are the big, Japan and South Korea are very material export markets for us. That is primarily LNG and coal, and the potential from Japan and South Korea to replace our fossil fuel intensive energy exports with green energy exports is actually really quite strong. There's a large amount of activity by Japanese and Korean companies in Australia at the moment looking to develop those opportunities. So let's throw that one in there. And you can see US is not, it is, what are we now? It is our 5th largest trading partner. So, we aren't a big deal for the US. The US isn't a particularly big deal for us in terms of that, the current tariff narrative as well. So that doesn't mean that if they impose tariffs on us, it wouldn't hurt us, but it's not, that is not going to be fatal for us. Our biggest exposure probably is anything they do which is detrimental to China is going to, that's what has the biggest knock-on effect to Australia. It'll be that indirect channel via China, not anything directly, probably. So I'm happy to sort of wrap up there, Evelyn, and then take any questions that people might have around it.
That's great. I'm going to stop sharing my screen so that everybody can see each other. But if you do want me to put any slides back up, just let me know. Yeah. Roger, I see you've got your hand up. Why don't you start?
Was that for me, Evelyn?
Yeah. No.
For Roger.
Oh, for Roger. Sorry.
Yeah, no, that's for me. Guy, a couple of quick questions. You talked about the tipping point around energy. I'm particularly interested in 2 things and like your commentary. You're starting to see huge issues around the oversupply in some cases of renewable energy, particularly wind and solar. You look at Western Australia, they're going to put 70 gigawatts of wind and solar over in a couple of years, as you would know, sort of down in the south east portion. So that ability to embed energy into products, and related to that, also where things are going in terms of advanced manufacturing, given, we're seeing a renewed interest in that, but it's kind of challenging when you've got tariffs happening and supply chains being disrupted. I mean, do you have any views?
Yeah, no thanks. So on the first one, we have, so as of right at today, I would say, yes, we have an oversupply on any given day, and particularly at around about 12 o'clock today, given it's nice and sunny here, we will have an oversupply of energy and the price of electricity will be negative. But in a structural sense, we are still well and truly undersupplied. If you think about where we're trying to get to in terms of, just looking at the government's renewable energy target, we're in, I don't know, 40-ish% at the moment on the, that's a fair way short of 83 last I checked. And but also if you project forward the future demand we're still well undersupplied. So there is there is absolutely a need for more energy. The other thing, which most obviously is, we have a whole bunch of coal-fired power stations reaching end of life. If they weren't there today, we would find ourselves with a massive structural shortage of energy. So there is a, as I said, there's a, there's, I would say, getting some more visibility on this. One of my board roles now is on the Clean Energy Finance Corporation. So we have the pool of money, the Rewiring the Nation pool of money,
Saw that.
$12 billion, and transmission is probably one of the biggest challenges around managing that. But to your point, I mean, the other interesting thing is the green if we have those green energy export potential, and particularly in the form of green iron, then we need a hell of a lot more green electrons than we're producing today. So, so I still think I would like to have a lot more green electrons and then have the luxury of working out what to do with them than being in the situation we are today. On the manufacturing point, I mean, one thing I suppose, the overarching impact of all the daily updates we have around tariffs on or off is, so one of the big, one of the professors at MIT was there, and when I was there, Pindyke was had one of his major outcomes, which most of you will probably not find particularly surprising, which is true of a lot of big economic insights, is if there's a lot of uncertainty, that's bad for business investment. And all of this tariff on and off, which part of the supply chain is it going to be hitting, whatever, is unambiguously bad for business investment, and particularly in the manufacturing space. So I think that, and that's true even in the US. In the US, companies are saying, where do I invest? How do I get around it? Where do I need to relocate my supply chain? That's, that is unambiguously, this uncertainty we've got at the moment is unambiguously bad for, I'd say, particularly investment in manufacturing and advanced manufacturing.
Do you see the geopolitical calculus, strengthening the need for, the repatriation or, having sovereign supply capability?
So that sits behind a lot of government policies right around the world at the moment. But from an economic principles point of view, there is, so this goes back hundreds and hundreds of years in economics, comparative advantage. So some people are relatively better at doing stuff than other people, and it's generally good for the world as a whole if those people are the ones doing it rather than someone else. So the person with the comparative advantage, generally better that they're the ones doing it. However, that doesn't completely take account of sovereign supply chains. That's true, but another way to put it is, if we went back to autarky, i.e., we didn't trade with anyone else at all, that is unambiguously bad for all concerned. So yes, you probably need to take some account of your supply chain, but repatriating everything onshore is unambiguously bad for everyone. Yeah. Ulrich, you got a question?
Actually, first, I think Michael had a question.
Oh, okay, sorry.
Yes, thank you.
And then we'll go to Ulrich.
Okay, further to your mentioning that uncertainty is bad for inflation.
Bad for investment, actually. Probably also.
I meant investment.
Yeah.
And on the point about massive investment in AI, I wanted to ask you if you have a snapshot view, like 20-second idea on macroeconomic justification for that investment in AI.
Yeah, I think it's so. There's one of my former colleagues, Darren Asamoghlu, has written quite a lot about this, and somewhat with Simon Johnson in just in the last year or so, about whether AI is good or bad macroeconomically. It's an interesting thing. So you can frame it in, we have had technological innovation for the better, for the better, thousands of years, and it's not unrelated to the current. There's always been these concerns, most obviously expressed by the Luddites, that this would be, end up with a whole bunch of people being unemployed. But here we are today, and pretty much everyone's got a job. And so the interesting question is AI just another technological innovation that we've seen different variants of over the last number of years, and it will all be sweetness and light going forward? Or is this finally the one which actually the Luddite concerns come home to roost? So that's sort of an interesting discussion happening at the moment. From a macro point of view, and this is still very much being debated, you can think of it as a what in macro terms is called a supply shock. So it's probably going to put potentially puts downward pressure on prices, at least once the AI is deployed. The investment side of things may actually be somewhat inflationary, just because there's a lot of activity in doing that, putting the investment in place. But in the medium term, it may actually be disinflationary. The other interesting challenge is, so one of my professors, Nobel at MIT, very famous guy, Bob Solow, Nobel Prize winner. Bob, talking about the tech boom, famously said that computers are everywhere except in the data. And it took a long time before you saw the impact of all the investment in tech back through the sort of 60s, 70s, and 80s to actually show up macroeconomically. And so there is an open question again now, is all of this investment we're seeing in AI, how long is it before it's actually going to really be seen in the macroeconomic data? And that's a very open and hotly contested question at the moment. So
I guess I was wondering, in terms of things, production factors, consumption aspects, how does AI figure, how does it contribute in those areas?
The interesting thing, to the extent, if you take the examples of, if you're an analyst at an investment bank, or if you're a clerk at a law firm, and AI is basically able to do all that stuff that you used to do, possibly not, that those jobs may be the ones which are going to be displaced by AI. Again, I think the general experience with the adoption of technologies like this is it's generally disinflationary. It puts downward pressure on prices because people are just able to do more stuff cheaper and quicker. So in other words, it's productivity enhancing, and that's generally disinflationary historically. The question here is how quickly and how pervasive will it be? And history isn't a really good guide for that, unfortunately. So we'll have to see how it, I think we're still in the wait and see phase. As I mentioned earlier, though, the investment program by the Magnificent Seven this year is on a scale which hasn't really been seen macroeconomically. And so the deployment this time around seems to be a lot faster and a lot more consequential potentially than it was even going back to the tech boom. So.
Great. Ulrich.
Yeah, Guy, I actually had a similar question in a similar vein in AI, given the world is having this AI moment. But I actually wanted to ask you about, in macroeconomist circles, how much attention from your perspective is AI getting right now, relative to tariffs and relative to all the other things going on? I wanted to just get your, temperature check on that.
I would say a fair bit. As I said, I mentioned that book by Duron and Simon Johnson that is generating quite a bit of debate as to whether their analysis or their thesis is right or not. I think people are absolutely on the lookout for it. As I mentioned, Bob Solow's quip, people are absolutely on the lookout for it appearing in the data, and so that is certainly true. I would say it's, and from a financial, as I said, I'm on the investment committee at ART. I'm also on the board of another FundsSA, which is the South Australian Government Super Fund. Every single meeting from an investment point of view, AI comes up. So from a financial point of view, it is just you can't get through any meeting without it coming up. So whereas the tariffs one I'd describe as much more, that's a the literature, the economic literature on that is sort of very mature, pretty well agreed. You can disagree on whether or not it's a good thing to do it or not, but the consequences are pretty well thought out. The uncertainty at the moment is just whether it or not it's going to go ahead. If it does go ahead, what happens is actually, everyone's pretty well in agreement as to how that plays out. Whereas AI, I'd say it's much more open debate and to some extent much more interesting from a macro point of view, because it's just so much uncertainty as to how it will play out. But yeah, so I'd say it's probably more attractive for the debate, the AI one, because the tariff one is, we pretty much understand how that's going to play out. It's only a question of when or if. So.
Oh, it's so interesting. I mean, obviously in tech and investing circles, it's all AI. Fascinating to hear that is also bleeding up into sort of macroeconomic circles already as well.
Yeah.
Guy, I have a question. So I work, I think, as you know, in the sustainability climate change space. And something I think about a lot is how we have a finite planet and you can't have continuous growth forever. So our kind of classical economic models run into a bit of a problem unless we can get some more Earths and more resources. Do you think that some of the big events that we're starting to see with the climate crisis, like LA being on fire as an example, are these now or potentially in the near future big enough that they're going to disrupt economies?
Yeah. So let me just start with your first point. And there's a really good book which I highly recommend you read by Daniel Susskind called Growth, came out last year.
Okay, I'll read that. I'd love to read that.
Part of the point that Daniel makes, so growth in terms of depleting resources, yes, there's a finite to that. But if you think about growth in terms of ideas, economic growth driven by ideas, then there isn't any obvious limit to that. Although AI is an interesting to think about in that context. But anyway, so I think that's what. So sustainable. So another way of pointing of coming at that is, I do think there is potential for plenty more growth, which is actually good for all of us in terms of living standards and the like. But there isn't, but looking at growth through the lens of sustainability is certainly important. It is important. I've actually done a fair bit in that space too, and doing some stuff in that space too. But so. Do we need to? And the other interesting thing, which is Daniel Susskind picks up in his book, is the GDP isn't actually, it was pulled together in the 1930s, basically, as a, and it measures some things well and other things not so well, and it takes account of some things and not account of other things. And so, but that's the metric that is everyone's sort of default go-to measure, and it's probably not the best way of it's certainly not the best way of trying to assess some of the questions that you're getting at, and so we do need to take account of that there's spending more money on security is good for GDP growth, but is it actually good for everyone's welfare? Not entirely clear. But we are seeing, though, to your question, big climate events starting to have a first order impact on GDP. We in Australia, the cyclones, the biggest example we had was the Cyclone Yasi back in 2012, where if you might remember, the banana prices went through the roof. You actually just couldn't get a hold of a banana. So that had a first order macroeconomic impact. Your neighbour would have been spending all its time or her time talking to you about banana prices back then.
I didn't live there then, but I have no doubt I would have had many banana conversations with my lovely neighbour.
Yes, that's right. That would have occupied most of your conversations, including if you could even find one. But so we are seeing the rise, climate-related disasters having a material impact on macroeconomies. Interestingly, so if you look at the bushfires here in 2020, they didn't really have, they were highly consequential and really had a big impact on the communities, not much of a macroeconomic impact. But you know, and I suppose one interesting analogy I like to think, you know, but floods and stuff like that tend to have much, then those you can see in terms of macro impact. Fires, actually, as it turns out, LA may be different because, you know, if it took out, you know, some chunk of the entertainment sector, for instance, then maybe you start to have a bit of a macro impact. But fires also tend to be more localized, you know, and I'm not trying to downplay their impact, but from a macro point of view, they're not so consequential. It's more things like hurricanes and floods and cyclones. They're the ones which are really having the macro impact. I mean, I still find it interesting. There's an interesting article in the Financial Times today. There's a huge amount of property building going on in the Florida Keys, notwithstanding the fact that last month they had two hurricanes come through and caused huge amount of devastation. And so, you know, those sort of, I think those sort of events are just going to be becoming more and more consequential.
Yeah, and you get things other than the events too. I mean, you get the overall impact on agriculture, and you get
so there's
stress kind of rising, and people not being able to work as many hours and that kind of thing, which aren't specific events. But certainly,
so there's a big discussion around that.
But in the next decade, we're going to increasingly see those things really having a noticeable impact in different economies. Yeah,
there's certainly a big discussion in the economics profession around the sort of the impact of temperature rising and increased humidity actually on sort of productivity and how that's going to play out for sure. So
great, thanks, Guy. Does anybody else have any questions? Feel free to just jump
I may have to run in a second because I've got but I can certainly take one.
Okay, one more question and then we'll call it.
Michael.
Michael, Michael, you just need to unmute yourself. Maybe I can do it.
Okay.
There you go.
Quick follow on from the time when I was a student at MIT. Club of Rome project, Limits to Growth, Jay Forrester's work, modeling developments through mid 21st century, precipitous catastrophic downturn around mid-century, like 25 years from now. Any thoughts about that in terms of
but so interestingly, that was more around, you know, we'd be depleting energy sources was one of the central theses from memory of the Club of Rome. And so that I don't think is going to be, you know, that's not playing out. You know, we kept on talking, there was a lot of talk about reaching peak oil because we'd run out of oil and found more oil, and then we found other energy sources, and now we have the potential for green energy sources. I don't think a shortage of energy is not likely to be a constraint on growth, which I think was a part of the Club of Rome's argument. So, you know, I think that, as I said, I would highly recommend people read Susskind's book on growth, which I could get answers some of these other, addresses that question a bit too. But it really is, you know, so sustainability is certainly going to have an impact on growth. As I said, Evelyn, it's not necessarily fatal for growth, if you want to put it that way. But
you need to think about it in a different way.
Yeah, exactly. You know,
how about population growth?
No, so population is an interesting one. So the developed world is basically, you know, and China is obviously, and Japan are at one extreme, is that we are now, you know, peak population is potentially in sight. If you think about, you know, a lot of the developed world is below the replacement ratio if you take out immigration. So, you know, it's, you know, Africa, yes, still plenty of population growth there, but a fair chunk of the rest, you know, but certainly weighted, you know, if you think about China, India, and a large chunk of the developed world, barely, you know, China and Japan, are below replacement ratio. The Japanese birth rate, I saw the story yesterday, you know, lowest it's ever been in history. So population is an interesting one to think about how that plays out, and it's plausible that actually peak population is actually in sight. So
I think we'll call it there because we've run over by more than 20 minutes. Guy, thank you so much for your time. This was a really fantastic, insightful talk, generated a lot of good discussion. And we will be putting the recording up on the MIT YouTube page within the next 2 weeks. I would like to say keep an eye out in your email and on LinkedIn. There's going to be a quarterly coffee next month, and we also will have another virtual talk next month. And if anybody else wants to volunteer to give a talk or wants to recommend a speaker, please do drop me an email. We'll see you at the next events in March.
Thanks.
Thanks everyone. See ya.